A very warm good evening, guys. Let's wait for 2 minutes. Let's wait so that others can join as well. And once we are a good strength to start with, then we'll start. Good evening, everyone. A very warm good evening to all of you. So we will be starting in next couple of minutes. Let's wait so that others can join as well. So guys, we will be starting with where we left off in the last class. That is about the advantages and disadvantages of fiscal policy. Okay. So starting with the advantages of fiscal policy, can anyone help me list down few of the advantages? Any such advantages of fiscal policy that you can think of? So one advantage that I can think of is economic stabilization. So if an economy is overheated, contractionary fiscal policy would help us to cut down inflation. If the economy is in recessionary phase, expansionary fiscal policy will help us to take our economic activities further. Yes. Second is SS is saying infrastructure development. True. Infrastructure development is due to economic policies. No, you didn't missed anything, Amisha. We just started with advantages of economic policies and we highlighted the first point, that is economic stabilization. And the second one is infrastructure development. Anything else that you guys can think of? Economic policies also helps to create jobs. So job creation, so job creations is the other advantage of economic policies. Well, someone SS is again saying better standard of living. True. If government is spending on infrastructure, yes, better lifestyle. If government is spending on infrastructure, Well, increased exports is more subject to advantages of monetary policy, but better standard of living or better lifestyle is one of the advantages of economic policy. Yes, a better economic policy or a better fiscal policy may be attracting more foreign direct investments. Poverty mitigation. Is it possible to mitigate poverty? It is possible to reduce it, but uh, it is slightly impossible to mitigate poverty, right? Because some of the people in any nation might be poor because of their choice. Please tell you hide that page. Which page are you talking about, Priyanka? Guys, is my page not visible? Is my screen not visible where I am writing all these points? Okay, so Priyanka, it has been visible to everyone else. Yes, better standard of living, increased standard of living is one of the point. Controlling inflation. Yes, controlling inflation is one of the advantages and more or less associated to monetary policy. So monetary policy are fluctuated to control inflation. Priyanka, I would just request you to rejoin or do something about your network because you are the only one facing this challenge. So probably there is an issue from your end. So AM rightly said that better fiscal policies. Yes, Shivam, please tell me what is your doubt and please don't raise hands. You can just directly comment your doubt in the chat box. So AM Apur rightly said that a better fiscal policy would have a better attraction of foreign direct investment. So it would also facilitate investment stimulus. So what is investment stimulus? It would invite investment in a particular geographical nation. Then again, exports and imports are with respect to monetary policies, how currency behave when interest rate rises, how currency behave when we reduce the interest rate. All these things, your currency appreciation, depreciation, all these things has more related to imports and exports of goods and products and services in and out of the nation. So I would keep exports and imports for the advantages of monetary policy that we already discussed. Now, what are the disadvantages of fiscal policy? What are the disadvantages of fiscal policy? Better relationship with other countries. That is foreign policies. That won't be the part of fiscal policy. How a nation wants to build a relation or geopolitical relation with some other country, it depends on the foreign policy of the nation. Well, the first disadvantage is time lag. So let's say this is an economic cycle and you discovered that the economy is in recession. So you implemented an expansionary fiscal policy. Yes, NS, tell me how can I help you? Naveen, please let me know how can I help you? So the economy is in recession and you implemented a expansionary, by you, I mean the government implemented the expansionary fiscal policy. It was implemented over here, but it started to show effects over here. It started The policies that you implemented started to show effects when the economy already reached at its peak. So the implementation of expansionary fiscal policy took the economy from here to here. There are other limitations of this as well, because already there was higher inflation, and expansionary fiscal policies led to more inflation. So time lag is one of the challenge in both monetary and fiscal policies. Leads to higher taxes if government is unable to control the spending within an acceptable limits, leading to stress in an economy. True, that is true. I'll come to that point as well, DA. Second point is political pressure. Often political parties try to make policies, both monetary and fiscal, and try to time the market, try to time the economy in such a way that they get the maximum benefit out of it. Economics will be completed in next 5-10 minutes. Okay, PP. So this is the concluding part. We are talking about economics. So often political parties, what they do is they try to make monetary and fiscal policies in such a way that benefits them in short run, but it may not be beneficial to the whole economy in the long run. Okay, so the policies that are made are subject to political pressures as well. Now, there is also an important term called as crowding out effect. Correct, SS. That is purely true, but that is not the case with every nation, right? Although government tries to make the standards in such a way that every person who is associated in filing the income tax knows that what is the logic behind paying the taxes, but unfortunately that is not the case in every nation, that not every citizen is able to understand it. Coming to the part where I was discussing about the crowding out effect. Let's say by following the phase of development and following an expansionary fiscal policy, government is trying to build on more and more infrastructure. If government need more and more infrastructure, they are following an expansionary fiscal policy. They will also have to, let's say the phase of the economy is in the intentions of government is to follow an expansionary fiscal policy. They will have to keep taxes lower. Now, if taxes are less, infrastructure development is in full swing, where will government fund this development from? Where will government fund this infrastructure development from? They are going to borrow money. They can borrow money within the country, or they can borrow money outside the country as well. So if the government is borrowing money from its own people, from its own bank, or the banks of the nations, it has been considered that there won't be much supply of money remaining for the common people as well as private businesses. Yes, Ji, so recently government received 2.1 lakh crore of dividend from Reserve Bank of India. We'll come to that. So Reserve Bank of India generated surplus interest income and they distributed those income to the government. Often earlier it was seen that government was making some political pressures in Reserve Bank of India in last financial year to distribute some dividends, and last year the dividends distributed by government was around 84,000 crores. So the increase in dividend, the growth rate in dividend that has been seen over here is approximately around 140 to 145%. So these few things also led to trigger the market. These few things led to Nifty making 900 points uh, upward move in last few trading sessions. Sir, in LMS, there are PDF of advanced Excel, which is of 185 pages, which contains a lot of Excel. I am asking whether we need to do load formula, and also there are a lot of Excel practice sheets. Confused where to limit the Excel learning, please help. So KG, basically when it comes to Excel, as much as you practice it, as better it is. But often there are innumerable formulas in Excel, and you are not going to use each and every formula in your daily life. So limit yourselves to those formula which you feel are going to be useful based on the job profile that you are going to hunt. So don't worry. Make sure that you know that how these formulas are implemented. Make sure that how is syntax implemented. What the Excel formula is asking you, and based on that you can make the model on Excel. So don't worry about it. You don't need to learn all the formula in Excel. No one in the world knows that how many formula or are there in Excel. And over the period of time, the more time you will spend on Excel, you will get to have an exposure on other formulas as well. Okay. So what is crowding out effect? If government is spending too much on infrastructure and borrowing the money, there won't be any money, supply of money available to borrow for common people and private businesses. Now that would discourage the business activities within a nation, and that is something called as crowding out effect. Now there are budgetary constraints as well. There are budgetary constraints as well while implementing the fiscal policy. What are these budgetary constraints? So let's suppose an infrastructure is to be built, like a nation needs or a city needs a 4-lane highway. A city needs a 4-lane highway. But if the government of that city or that state or the central government of that nation does not have enough money to fund that infrastructure development, then will the government or will the city be able to witness that infrastructure development? The answer is no. If the government of that particular nation does not have that money, how will they fund those infrastructure development? There is a limit to borrowings, right? You cannot just keep on borrowing from the world. It creates a serious geopolitical pressure on a particular nation. The countries, developed economies which lend money to underdeveloped or emerging economic countries expects a lot from them, and that could also be at some point of time compromise their freedom. Also, one disadvantage of fiscal policy is regional disparities. In some region of the nation, you will see the economy is the infrastructure development is very high. On the other hand, on the other region of the nation, the infrastructure development is very low. So government, this causes a regional disparity. One city of a nation might be very well developed, competing to one of the best infrastructures around the world, and one city of the nation may be under the bottom of the table. So that is a serious issue when it comes to the disadvantages of fiscal policy. So VB, don't worry if you are late. Just go through the recordings that will be uploaded on the LMS. We are discussing advantages of fiscal policy and disadvantages of fiscal policy. Please try to be on time from next week onwards, or from tomorrow onwards. So we have discussed advantages of fiscal policy and disadvantages of fiscal policy, and these are the points that has been highlighted. Now, there are few more points to the disadvantages. So I'll just keep it over here as well. So basically, what is crowding out effect? Let's suppose, Arjun, you want loan from the banks. You want to come up with a project to set up an energy production plant, and you need $500 million to fund that project. But since government is investing so much on infrastructure, there is no $500 million available to the banks to lend it out to you. So how could you be available to these funds? You won't be available to these funds, or these funds won't be available to you. So that is an example of crowding out effect, where the government is borrowing so much there that there is no borrowings available, no money available to lend out to the common people. Are you clear with this, Arjun? Yes, KG, that would be fine, sufficient enough. Now, the other thing is long term, you may call it a disadvantage, that it is fiscal policies comes with a long term commitments. So if you have decided that you are going to make this particular region of the geography a smart city, for example, where you will load this city with high technology, better infrastructure, and so on. Probably you decided in year 2020 that you are going. Sure, Urvashi, I'll explain that. Don't worry. Just give me a second. Let me just complete the 6 point and I'll explain all the 6 points together. So, what is long term commitments? Let's say budgetary constants and regional disparities. I'll explain all the 6 points. I'll summarize all the 6 points again. Don't worry about it. Just give me some time. Let me just get done with long term commitments and then I'll explain all the 6 points. Okay. Yes, I'll explain advantages as well. Don't worry. Next time onwards, guys, if you feel that you have any doubt, please let me complete the explanation part and then stop me. Please don't interrupt me midway. That is a sincere request from my side. Okay. Now, what is long-term commitments? Let's suppose you decided in 2020 that you are going to develop a particular geography of a particular nation. You are going to spend $300 million in that nation and make it with a well-equipped infrastructure, well-equipped and well-developed technologies. But suddenly in 2021, so this was a long-term project. This was a 5-year plan to develop that particular economy or particular geography or particular city. So the project was expected to start from 2020 to 2025. And by 2025, the project was expected to be completed. But again, in 2021, some uncertain consequences like COVID-19 happened, a pandemic happened, and the overall economy wasn't a very bad situation. So what I mean to say over here is that the fiscal policies, when it is implemented, comes with a very long-term commitment. So you cannot just change it every day. It is not very flexible, if you see. Okay. In some cases, it could be flexible, like taxes could be interchanged here and there. Government has a right to do that, and it could be implemented very quickly as well. But ideally, fiscal policies are somewhat very stringent and they cannot be cancelled and made every now and then. However, I'll explain all the points. Don't worry about it. let me just complete all listing down the disadvantages. There are two more points. That is global interconnectedness, that any fiscal policy that you will make for a particular nation, it will have impact on other nations as well. So if you are developing the infrastructure or of your country, probably you may borrow it from some other country, you may borrow some money from other country, or there might be your competitor who is suffering due to your development, because since you are developing the infrastructure, businesses are foreign inflows are coming to your country. And earlier, before your country was an option to invest in, earlier there was some other country like country B, let's say. So that country may suffer as well. So any fiscal policy that a particular country makes, it has its impact on the global parameters as well. So apart from that, there is uncertainty as well, how the market or the economy will react to the situation that you have made. So government, one of the example of it may be, so I will club these 2 points, uncertainty and unintended consequences. So again, pandemic was the example of uncertainty. There are some uncertain economic activities or uh, biological activities might happen in a nation that could cause the uncertainty of the implementation of fiscal policies. Um, so that can also be considered as advantage of fiscal policy. Yeah. So subsidies are one of the examples of fiscal policies that are helped. But all these things, all these schemes would come under the subsidy section. Okay. Then unintended consequences. Let's say, for example, that in order to encourage people to spend less and control inflation, yes, Russia-Ukraine war is one of the uncertainties that you can give an example for. To control inflation, what would the government do with taxes? Let's say government has cut down taxes. Will the government cut down taxes to control inflation, or will they hike taxes? So PK, I guess PK is asking me to please explain the role of RBI, central bank, investment bank, and other bank. So for investment bank, we have other hold together a different module. The correlation, RBI is a central bank of India, and what are the roles and responsibilities of central bank is in detail covered in our past session. So I would request you to go through it, and how banks and central banks react with each other, that is also covered over there. So control inflation, hike taxes. But so let's say government has hiked taxes in order to control inflation. The impact of which what happened is many people are not filing their returns, income tax returns. So government has seen a sharp fall in the people filing their returns, income tax returns to save taxes. So these are unintended consequences. The intentions of government were to control inflation, but it uh, caused the effect that most people stopped filing the income tax returns. So these are the example of unintended consequences. Now, highlighting everything, summarizing up everything that we discussed as of now. So advantages of fiscal policy is economic stabilization. It helps the overheated economy to cool down, that is from a peak phase to a to a phase where the inflation is less, and it helps the recessionary phase of an economy to recover. So that is economic stabilization. It helps in infrastructure development, and that would in turn cause a better standard of living. If there would be better infrastructure accessible to all, the standard of living of people using that infrastructure would definitely develop. Since developing this infrastructure would require labor and labor force, there is job creation in the economy, and a better infrastructure would involve inviting the foreign participants and also the business activities growing in a particular domestic business activities growing in a particular nation. So that is investment stimulus. So a better infrastructure, a better fiscal policies encourages investment stimulus. The disadvantages are it suffers from a time lag. It may take a quite good amount of time for the fiscal policies that you have executed now to get implemented actually in an economy. Uh, yes, better allocation of funds to different sectors is one of the advantages that would come under investment stimulus. So disadvantages of fiscal policies is also it is suffered from political pressure. Offer political parties tends to make fiscal policy in such a way that it would impact their vote bank in a positive manner, and it may not be healthy for such it may not be healthy for such fiscal policies to be implemented in the long run. Now, the second is crowding out effect. So crowding out effect, we have a detailed discussion on it that when government would borrow more and more and more, there won't be any money or funds available for people to borrow it. The common people and private companies, private businesses won't be able to borrow that. That would discourage private business activities within a particular nation, and that is crowding out effect. The next point is budgetary constraints. So let's say if I want to uh, make India make if let's say if I want to invest in India and make $20 trillion of investment in India and develop infrastructure, but the budget that may be allocated for the development purpose may be only $5 trillion or $3 trillion. So how would I be able to make the investment of $20 trillion? So that is the budgetary constraints. Everyone there with me till this fourth point? Everyone, those who had doubt, those who has asked me to repeat this. Yes, Karuna ma'am, please tell me how may I help you? Which point do you want me to repeat? Everyone there with me? It would be uploaded on LMS. Don't worry about it. It would be uploaded on LMS. I'll share these notes with you as well, and the PDFs will also be uploaded on the LMS. The third point is crowding out effect. Let's say if there is 300 million available to lend in a particular nation, and governments borrows these 300 million to develop an infrastructure, will Shivam, you and me be accessible to the funds? The answer is no. So that is what crowding out effect is. Government borrows so much more that the people are not available and accessible to the funds. So so you can see the crowd is not accessible to the funds. That is crowding out. And obviously, if government is spending so much on infrastructure, they will have to borrow it if they are not able to fund it from their own. Under the notes section, so if you are facing any challenge in finding any of the PDF, you can go on the notes section or raise a ticket about it. The team will help you out for the same. How is it because of fiscal policy? Why crowding out effect is a part of fiscal policy? Simply the reason being that crowding out effect refers to when government borrowed to develop the infrastructure. Government borrowed to develop the infrastructure, and development of infrastructure and spending on infrastructure is related to fiscal policy. That is why crowding out effect is related to fiscal policy. You So Shivani, basically the first point says that it takes a lot of time for what you have implemented today to get affected in an economy. So let's say that you have, please try to relate this with long-term constraints. So you have managed to invest in a particular infrastructure now. You have managed as a political party or the government to invest in a particular city now and develop it. But it would take time to develop it, right? So that is time lags. Fiscal policy and both monetary and fiscal policy suffers with time lag. It is not that you will implement it today and it will came in effect from tomorrow. It takes some time to get it implemented. Budgetary constraints points make no sense. How is there is a larger amount available to be invested? That means the market trusts the economy enough. Then why would not take into account when creating the budget? Mostly countries plan a higher budget and are unable to pay back, but not the other way around. Or is there any example of it? Where can we get the whole syllabus? You can raise a ticket about it. The team will connect you and they can help you out. Sir, how the printing of money affects the fiscal policy? Just give me that is related to, so why government cannot be keep on printing money. That is what we discussed in the last class, I guess. Regional disparities. I'll come to regional disparities. Just give me a second. MS has a doubt that budgetary constraint points makes no sense. How? So what is first of all budgetary constraint point? So let's say if what is budgetary constraint? Forget about the economy for a matter. Let's say MS that you need to buy a car. You need to buy a car worth rupees 2 lakhs and you just have 50,000 for it. So will you be able to buy that car that was worth 2 lakhs? You will have to shift to a car which is somewhat less of a variant of that particular car that you aimed for. Similarly, if a government wants to invest 50 lakh crore, let's say, in a particular economy, is it possible that whatever the government wants to invest, they will be able to allocate that funds? No, there might be some policies, there might be some cases where the government is not able to fund the project. And that is what budgetary constraints tells. So you might have often heard from the political parties that the budget is tight, the budget is not available to develop that particular infrastructure. So these are the excuses given by the politicians. That is what is highlighted over here in the same form that you wrote in the class. So I wanted to ask whether the notes will only in your handwriting or is it computerized form. So it will also be available in the PDF form, but it will be available once we are done with the whole module. So it is uploaded module wise. Once since today we will be done with economics, it will be uploaded today on the LMS portal. Okay. So those who had any doubts, MS, you had doubts about the budgetary constraints. Now are you clear with it? Regional disparities. Some region of a nation might be witnessing high development in infrastructure and some might not be witnessing the development at all. So that is what regional disparities is. There are still many modules incomplete regarding any syllabus. Syllabus doubts, you can just raise a ticket about it. Because I won't be able to comment accurately because I don't know your batch number, right, Srushti? Then what is then there is long-term commitments. Long-term commitments, we already saw that for fiscal policies to be implemented, it takes a certain amount of time according to the plan. We cannot implement and take back the fiscal policy every now and then. So not only about the economics, for every module that we are going to cover, there would be in total 6 exams that you will have to write. 6 plus 6, that is 12 exams. 6 would be objectives and 6 would be subjectives. So based on that, please prepare yourself. But all these exams would be taken once you are done with the curriculum. At last, once you are done with the curriculum, you will be taken with that exam. After you guys are done with the teaching part of the curriculum, then you will be having your mock interviews. Global interconnectedness, whether every policy that you make has some global impact, and that is what global interconnectedness says. Uncertainty is like pandemic or war-like situations happens between geopolitical tensions between nations, that leads to uncertainty of fiscal policies and unintended consequences for the government. So finally, we are done with fiscal policy. The concluding remarks would be it is essential for policies to coordinate with each other. It is essential that the government uh, organize the policy in such a way that it benefits the nation and people of the nation. Policies are made for the cyclical responses. Economy moves in cycle from recession to peak to trough, and this is a continuous process. Well, the government and the central bank has the toolkit with them in forms of policies that helps them to manage the economy. When our exam schedule. So once you are done with the teaching part of the curriculum, once you are done with all the lectures of the curriculum, then you will be having your exams. Also, when policies are made, it should be considered that the perspective is long term. There should be a long vision of consideration that how it is going to affect this particular how this particular policy is going to affect the economy 10 years down the line. That is what you should think. Yes, you will be done DAs in some time, like 3 4 weeks more, 2 3 weeks more. Yes, after exams, you will be having your mock interviews, guys, about the schedule, what will be the flow, all these things. Please go on raising a ticket. Please don't ask me during the sessions. It definitely interrupts the time of me as well as the class. So please raise your ticket if you have any doubts regarding when will be the exams, what would be the exams, what would be the questions, all those things regarding exams and mock interviews. You can raise a ticket about it. The team will connect you, and you can just go on for a half an hour talk with the representative, and he will help you out. Government should, while implementing monetary and fiscal policy, should also consider the challenges and trade-offs. Now, what are these challenges and trade-offs? They should think that what would be the repercussions of implementing this fiscal policy or monetary policy, and what would be the effect. What if I am if I am increasing the interest rate, for example, it is it is helping me to reduce inflation. But what is the trade-off? If this inflation is being reduced, it is at what cost? What is the cost of reducing the inflation? The cost is increasing unemployment. So these trade-offs are something that need to be considered before making the fiscal or monetary policies. It should be the policies that are made should be adaptable to the nation. The context should be clear at what is the purpose of making a particular policy. So with this, we are done with economics. I hope you enjoyed the economics part. The next module that we are going to start with is derivatives. So guys, do you have Are you guys ready to start with derivatives, or do you have any doubts regarding economics? Any point that you need to discuss about economics? Or shall we start with derivatives? I know economics was a bit of a lengthy topic. It took us a lot of time. It had many complications as well, but guys, that was the need of the hour. So thank you guys. I hope you enjoyed the economics part. So yeah, you can work for economic research analyst, macro or microeconomic analyst, economic research analyst. So you can hunt from those profiles that involves you for uh, making economical researches or research based on economics. And if you are a research analyst, you will be following a top-down approach or a bottoms-up approach. That is industry, company, sorry, economy, industry, and company analysis, or company, industry, or economic analysis. No matter whichever approach that you follow, you will have to come across economy, that is for sure. So let's start with derivatives, guys. What is your idea of derivatives? Thank you, GA. Thanks a lot. How many of you have heard this word derivatives for the first time? So few of you I can see are defining derivatives. Some of you are saying that you have heard this word for the first time. Contracts between two parties. Okay. So I'll highlight some of you what you guys said. Derivatives are financial contracts that derives its value from an underlying asset. Derivatives are financial contracts which derives its value from an underlying asset. Derivatives are contract between two parties. In futures and options, derivatives are used something which derives the value from an underlying asset. Derivatives derives value from an underlying asset or group of assets. Derivative is a type of financial contract. Derivatives is used for hedging. It's a contract between two people for an underlying asset. Forward swaps, etc. Derivative market, option, future swaps, investment vehicle. Okay, PT, when you will send a message once, it will be delivered to me. Don't worry, your message box is working just perfectly fine. You don't need to keep on posting the messages 5 to 6 times because it will. What would happen because of that, PT, is I won't be able to see the messages of other people and it will just go down. And some important messages could have been missed. So I would just request you, PT, to post any doubts or any messages or any answers just for once. So yeah, derivatives are financial contracts that derives its value from an underlying asset. So what is derivatives? As the name suggests, derivatives are financial contracts. So PM, don't worry, we have just started with derivatives and we have not even started yet. We have just defined what is derivatives. Derivatives are financial contracts that derives its value from an underlying asset. Now let's say there is a farmer. Yes, RT, remind me at the end of the class, I'll share those videos. What is underlying assets? Okay. So let's say, so let's say I entered into a bet I entered into a bet with an iPhone user. So there is me and an iPhone user. So why I'm using this name? Because what is underlying asset? That was the question from an iPhone user, and I'll request him or her, whoever it is, to rename your Zoom ID to whatever name has been given to you. So I entered into a bet for an India versus England match, where I bet that India is going to win, and the iPhone user says that England is going to win. So if India wins, I win $100, and if iPhone user wins, he wins $100. Now, whether I will get this $100 or not is dependent upon whether India wins or not. So here the cricket match is an underlying asset. Over here, the cricket match is an underlying asset. Similarly, if I am going to bet, now coming to a bit financial perspective, if I'm going to bet that today Reliance price, the share price of Reliance Industries will go up, and the iPhone user says the share price of Reliance Industries will go down. So whether I am going to, so I have bet 100 rupees that the share price is going to go up, and the iPhone user has bet 100 rupees that it is going to go down. So whether if it goes up or down, that is altogether a different scenario. But what is the underlying asset over here? It is the share price of Reliance Industries, because whether I will win this 100 or whether I will lose it, or how much out of this 100 I will win, is being derived from the value or the price that Reliance Industries is going to have. It will be dependent on the share price of Reliance Industries that whether I am going to win or not. So the contract is made based on an underlying asset, and that underlying asset, underlying LYING, not underlying asset, but underlying asset, can be stocks, bonds, commodities, or any other securities. Even climate can be an underlying asset. I'll give you an example how. So everyone clear what is, no, that is not a contingent asset. That is a real asset and a underlying asset. Contingent are nothing but conditions. So there are various conditions associated to that asset, but that is not a contingent asset. Sure, I'll repeat, don't worry. So derivatives are financial contracts that derives its value from an underlying asset. Now, what these underlying assets can be? These underlying assets can be stocks, it can be commodities, stocks like Reliance stocks, Tata stocks, Adani, Ambani, any of the stocks. It could be bonds, it could be commodities, it could be gold, silver, iron, wheat, copper, and derivatives is mostly used in commodities market and widely used in commodities market. Well, there are different sections of derivatives like forward, futures, options, and swaps. And options and futures are basically used when it comes to securities. or stocks. Well, the implementation of derivatives has a huge impact in commodities market as well. So there is nothing discussed about derivatives yet, but we are going to discuss a lot of things. So go through this one line definition. Let's go on a short break, a 5 minutes break. Make sure that you are right back on time. And we will be starting with the main content of derivatives. So underlying asset means the asset based on which the contract is made. So if I am entering into a contract based on gold prices, my underlying asset would be gold price. If I am making contract based on silver prices, my underlying asset would be silver. If I am making a contract based on Reliance shares, my underlying asset would be Reliance shares. So that is an underlying asset, simply the asset based on which the contract is made. Now we are going to see, don't worry about it. Don't worry. Don't burden yourself up with the definition. We are going to see that how two parties enter into a contract, and then you will be more clear that, about what underlying asset is actually is. So just go on a 5 minutes break, guys. Freshen yourself up and be right back on time. No, guys, there is no connection issue. So we were on a break, and if you guys are ready, let me know. If you guys are back, let me know so that we can start again. Shall we start, guys? Are you guys back? Perfect. So let's say, guys, let's say that there is a farmer who has produced cotton. There is a farmer who has produced cotton and he is going to sell cotton after 3 months. The farmer is going to sell cotton after 3 months. Now, cotton over here is an underlying asset. Before coming to that, think logically, guys, and tell me what is the farmer afraid of? What does the farmer don't want to happen? The option A, prices of cotton to go up or the prices of cotton to go down. What does the farmer don't want to happen? The prices of cotton to go up or prices of cotton to go down. Because he is going to sell the cotton in future. He is going to sell the cotton 3 months. Fast forward from today, he don't want prices to fall. Correct? He don't want prices to fall. What he would want is either the price should increase or at least remain same. What he would want either the price should increase or at least remain same. Now, my dear friends, this cotton producer farmer, this farmer will be tensed for the next 3 months. This farmer will be tensed for next 3 months related to what? Related to prices of cotton. Am I correct? He is going to track each and every day what is the market price of the cotton. He will be tensed about the prices of cotton for the next 3 months till the time he has not sold it. Can there be any financial instrument or a contract which can be introduced today itself, which can be signed today itself, so that this farmer is hassle free for the next 3 months? Can he enter into a contract for the for can he enter into any financial contract such that he can be hassle free for the next 3 months? So basically, PM Pragati wants me to explain in brief again. I'll explain. So basically, there is a cotton producer, farmer Pragati, and he wants to sell the cotton after 3 months. Since he wants to sell it, what he want is the price should not go down. So if the market price will go down, he will make a loss. So what he would want is either the price should remain same or either the price should increase. Now, now the question is, if he is expecting the price to remain same or increase, he will have to take the tension for the next 3 months. He will be tensed about the prices of cotton for next 3 months. I am asking you, Is there any way through which he can be hassle free for next 3 months? He can enter into such a contract through which he he can assure and lock the prices. What would be the prices after 3 months? So let's say the current price of cotton is 12 rupees. Let's say the current price of cotton is 12 rupees per kg. What if a farmer enters into a contract with a textile manufacturer or a textile producer where the textile producer promises to buy the cotton after 3 months and the farmer promises to sell the cotton after 3 months at the price of 14, which is this price 14, which is determined today. So what is happening? Farmer is selling, farmer has agreed, farmer has promised to sell the cotton at 14 rupees after 3 months. Farmer has agreed to sell the cotton at 14 rupees after 3 months, and the textile producer has promised to buy the cotton at 14 rupees after 3 months. Are you guys clear with what is happening over here? Are you guys clear with this? Okay. What if the price decreases? Very good. Okay, very good. I am getting few doubts. That is really exciting. But till now, this is the scenario clear to you. There is a farmer who is going to sell the cotton after 3 months to a textile producer who is going to buy the cotton after 3 months at the price that has been locked today itself of 14 rupees. Now, what if, let's say today market price is 12. What if price of the cotton, what if price of the cotton is 10 rupees? Scenario A, where price of the cotton after 3 months is 10 rupees. Scenario B, the price of the cotton is 14 rupees. Scenario C, the price of the cotton is 18 rupees. What will happen to this contract? This contract won't be affected by any of the price changes. That is the whole point of signing the contract today, right? Once the contract is formed, that is correct, PJ. Once the contract is formed and the prices have been locked in, the prices, it won't matter whether the prices are increasing or decreasing. Farmer will have to sell this for 14 rupees and textile producer should ideally buy this. Textile producer should ideally buy this for 14 rupees. Farmer should ideally sell this for 14 rupees and the textile producer should buy this for 14 rupees. No matter whatever may be the price in the market. But they are the mutual parties. They are the counterparties. Guys, who is going to create the contract? The farmer will enter into a contract with the businessman or the textile manufacturer. So farmer is the counterparty for the textile manufacturer and textile producer. Textile manufacturer is the counterparty for the farmer. Are you guys clear with this? So these are two parties involved in this contract. So this contract is nothing but a forward contract. What is a forward contract? Forward contract, again, a financial contract between two counterparties to buy or sell an underlying asset on a future date at a price predetermined today. And by today, I mean the date of the contract on which it is signed. Okay. Everyone clear what is forward contract? Everyone clear what is forward contract? Now tell me, guys. Now tell me that a AC manufacturing company like Whirlpool or Voltas or LG or Voltas would buy forward on temperature, or would they sell forward on temperature? Are they guys going to buy the forward on temperature, or are they guys going to sell that forward on temperature? Think about it. Take a couple of minutes, MS. If you have any doubt, you can post it on the chat box. They can do both. Buy, sell forward on temperature. Okay. Sir, what is your doubt, MS? Who is the creator of the contract, the farmer or the businessman? Both are the mutual creators of the contract. No one can force anyone or the other one to enter into the contract. Both have mutually agreed to come into the contract. Let's say, MS, if I am buying a land from you, who is the creator of the contract that we are going to sign? Both of us, right? Similarly, both of us are the creator of the contract. So, AC manufacturer, when think, think, always think, guys, whether the AC manufacturer is going to benefit from rising temperature or falling temperature. Whether they are going to benefit on rising temperature or falling temperature. They are going to benefit on rising temperature. These guys are going to benefit on rising temperature. So this is a green sign for them. On the other hand, if the temperature falls, it is a red sign for them. While, my dear friends, if they are scared of falling temperature, what would they not want? They don't want temperature to fall. They won't want temperature to fall. And similarly, like prices, if I don't want prices to fall, I will sell the price. I will sell the commodity. Similarly, if the owners don't want temperature to fall, or are scared of falling temperature, they are going to sell the forward on temperature. Now what happens when the temperature falls, when the temperature falls, they are going to benefit from it. They are going to benefit from it through forward contracts. And if the temperature rises, they are going to benefit from it from their business operations. So what is a forward contract? Forward contract is basically a contract which is being decided between the two counterparties to buy or sell a underlying asset on a future date at a predetermined price decided today itself. So always think that, okay, taking one more example, what okay, just give me a second. Okay, here textile producer in green flag, company wants to buy AC. No, the company wants to increase, company wants the temperature to increase more and more, because more the temperature, higher the heat, the AC sale will be rising. The sale of AC will be rising. So that is why rising temperature was a green flag for the company, falling temperature was a red flag for the company, and they were afraid of falling temperature. That is why they sold the temperature forwards. Now, coming back to this again, we we thought about this case from the farmer's perspective. Think about the textile producer perspective. Think about the perspective of textile producer. Would the textile producer want the prices to rise, or would they want the prices to fall? They would want prices to fall, correct? So what is the green flag for them? Falling prices of cotton are green flag for them, and rising prices are eventually red flag for them. If they are afraid of prices rising, don't you think they will buy the forwards today itself? They will buy the forwards and lock the prices today itself for them. Lock the price at which they will buy. Getting this, guys? Getting this, everyone? Everyone. So what are the two positions that you can take for on a forward contract? The two positions that you can take in a forward contract is either you can buy the contract, or else you can sell the contract. When you are buying a forward contract, when you are buying a forward contract, you are going long on the forward contract as well as long on the asset. You are taking a long position in the contract. It has been said in technical terms that you are, if you are buying anything, if you are buying a security, you are taking a long position in it. On the other hand, when you are selling a security, you are taking a short position in it. So be comfortable with these words, guys, because these are going to be used more often from here onwards. When you are long in a particular asset, you are expecting the prices to rise. That is why you have bought it. On the other hand, when you are short on a particular asset, you have sold it. Okay, everyone with me till here? So if you are buying something, you have taken a long position, and if you are selling something, you have taken a short position. That is what SC, buying and selling, is. So Susan, what is buying and what is selling? If you have bought gold in your portfolio, if you have added gold in your portfolio, it would mean that you have taken long position in gold. If you have sold the gold in your portfolio, from your portfolio, then it means that you have taken short position in gold. So if you are buying a forward contract, you are taking the buyer over here. Who is the buyer? The textile producer is the buyer of the cotton. He has taken the long position. On the other hand, the farmer is the seller of the cotton. So farmer, my dear friends, over here is taking a short position. Everyone clear till here? Long and short. Shivani, was this example well explained? Please let me know. Or shall I go for another example? Sure, we'll go for one more example. Simply, buying means taking long position. Selling means taking short position. If I am buying gold, I am long on gold. If I am selling gold, I am short on gold. If I am buying cotton, I am long on cotton. If I am selling cotton, I am short on cotton. Similarly, over here, farmer was selling cotton and hence he was short on cotton. The textile producer was buying cotton and he was long on cotton. Clear, guys? Everyone clear with this? Long and short are the technical terms used in derivatives markets. Everyone, shall we move forward? Shall we go ahead? Now, taking the same cotton example, guys, let's say that the current market price of cotton is rupees 12. That at today's date, the cotton is being traded in market at 12 rupees per kg. 3 months from today, what should be the price of the cotton? If I ask you personally, what should be the price of the cotton that I and SK should finalize after 3 months? What should be the lock-in price? Should the price be greater than 12? Should the price be less than 12? Or should the price be 12? Should the price be greater than 12? Should the price be less than 12? Or should the price be just 12? Most of you are saying greater than 12. Okay, that is one of the scenario. It could be greater than 12. I agree with you. Could the price be less than 12? Yes, the price could be less than 12 as well. Could the price be equal to 12? Yes, the price that we can agree upon can be 12 as well. Is there any fourth scenario that can happen? Or have we covered all the mutually exhaustive scenarios? Very good. So PJ is saying the farmer would want the price higher than 12. The textile producer would want the price lower than 12. Let's say the quality of cotton is same throughout the period. L- How will the price be determined? Farmer is saying the price should be 18, and the textile producer is saying the price should be 8. So how can the price be determined? First of all, there are two terms. There are two terms to these things. If the prices are greater than 12, let's say the prices are 14, it means that future prices or forward price is greater than spot price. The price that is prevailing today in the market is called spot price. What is the price that the cotton is trading at today in the market called? It is called the spot price. Spot price is the price on the spot. What is on the spot of cotton? On the spot price of cotton, it is today's price. Okay. So spot price is 12 rupees. If the forward price is 14 rupees, it means that forward price is greater than the spot price, correct? If the forward price is 14 rupees, everyone with me, guys, everyone with me, please reply. Please reply yes or no, because from here onwards, I need 100% of your attention. So if forward price is greater than spot price, if forward price is greater than spot price, the market is said to be in contango. The market, what is the state of the market? The state of the market is in contango. On the other hand, if the price is 10 rupees, it means that forward price is less than spot price, or spot price is greater than forward price. In this case, what is contango? Everyone with me. What is contango? Contango is called to be a term when forward price of the commodity is greater than its spot price. The term coined when the forward price of the commodity is greater than the spot price is called contango. Everyone with me? Everyone? Shall I introduce you to the next term? Next is, if spot price is greater than the forward price, what is contango? Contango is the term coined to represent that the forward price of the commodity is greater than its spot price. It means that 12 rupees is the spot price, and the at forward in a future date the commodity is trading at 14 rupees. So if forward price is greater than the spot price, the market is said to be in contango. Is this clear, JS? Jagannath, is this clear? It is used for each and every derivatives. Not only for commodity, it is used for shares. Wherever there would be a forward contract, there would be these terms used, and these terms would be applicable. Now, in the second case, when the spot price is greater than the forward price, the market is said to be in backwardation. If spot price is 12 rupees, it is also applicable in futures contract, but we have not jumped to the futures yet. So don't just keep on jumping to the next topic. We'll come to that, Priyanka. Don't worry. Otherwise, people will, if I keep on introducing new concept every now and then and don't explain it, you and your peers can also get confused, right? So I'm refraining myself for coming to or discussing anything about futures yet. So today's price is 12 rupees. The forward price is 10 rupees. In this case, the market is said to be in backwardation. On the other hand, when today's price is 12 rupees and prices has increased to 14 rupees, market is said to be in contango. So there is no such term where the spot price and the forward price is equal, and rarely it has been seen that the spot price and the forward price is equal. So there is no such term for what? For spot price and forward prices to be equal. But that is also a possibility, although with a very less probability. Now, my dear friends, think logically and tell me whether in general market should be in contango or in backwardation. Whether the market should be in contango or whether the market should be in backwardation. You guys are correct. From any perspective, from a logical perspective, should the market be in contango or should it be in backwardation? Contango is good for market. 12 price is for what? It is cotton prices. We have taken cotton in our example. So today's price for cotton is 12 rupees. This is what we have assumed. So there are various theories involved. Various theories involved on whether the market should be in contango or backwardation. There are various theory involved associated to it. Okay, there are various perspectives to it. Buyer will think about backward, seller will think about contango. Textile producer pay more, it means he will charge more, product price will rise. So PJ is thinking from a consumer perspective, some of you are thinking from a producer perspective, some of you are thinking from a buyer perspective, some of you are thinking from a seller perspective. Whether the market should be in contango and backwardation, there has been various theories to it with various justifications involved. Give me a second, guys. Let me take a sip of water and I'll be right back in a second. I'll just be right back in 15 seconds. Fair enough. So whether a market should be in contango or whether it should be in backwardation, various school of thoughts give various explanation to it. The first theory, with the name of the theory is insurance theory. The first theory, which is insurance theory, says that market should always be in backwardation. The insurance theory says that market should always be in backwardation. Now, those who commented, those a couple of students, 3, 4 students who said that market should be in backwardation, won the debate over here. Now I want those students who said that market should be in backwardation to give a logical explanation for it. SS says backwardation is good for the counterparty who sells because the deal is in more price at compared to market price. Okay, that is completely opposite you are saying. So if the market is in backwardation, spot price would be greater than the future price. So one who is selling will have to sell it at a lower cost. So that is completely illogical. Insurance theory says that insurance theory says that the farmer when the market is in backwardation, the price of the product is under control. The spot prices has hardly few things to deal with future prices. So what price I and DK you are agreeing upon, what has it to do with the market price? Obviously, demand and supply forces play an important role in determining the price, but still, that is not 100% satisfactory response for the market to be in backwardation. Here they are saying it will always be in backwardation. The market will always be in backwardation. How is it possible? They are justifying it that the producers of the assets, let's say for an example, commodity producers wants to wants to hedge their risk, hedge their risk. Commodity producers wants to hedge their risk. Now I won't go forward before explaining what is hedging. I am making a box over here. What is hedging? Hedging means you guys are correct. Hedging is the process of minimizing the risk or cutting out the risk, cutting down the risk. The process of cutting down risk or minimizing risk is called hedging. Now, over here, when we took an example of farmer and textile producer, the farmer hedged himself, the farmer hedged himself from the increase or decrease in commodity prices. He is completely unaffected by the prices of commodity 3 months down the line. It means that he has hedged himself. Let's say what SS says. Sir, spot price fixed at 12, and due to backwardation, selling party don't sell in 10. Now, because contract is already done, so other seller in market may sell it in, but he's selling in 12 because pre-contract done. So why this is not good? I'll come to that. That is called counterparty default risk cases. And that is one of the characteristics of forward contract. But I have not came to describing the characteristics yet. Just give me some time. In next 5 minutes or 10 minutes, we will be there and you will get the answer to your question. So that is one of the way of hedging GV. GV is saying that we take long and short positions simultaneously in an asset or an index and we hedge ourselves. So that is one of the process of hedging. But in general, hedging means minimizing risk. So when the current price, that is spot price, is 12 rupees and the forward price is 10 rupees, it means that the market is in backwardation. Something worth 12 rupees as on today, 3 months down the line, let's say this is F3, 3 months down the line, the farmer is selling it for 10 rupees. Farmer is happy enough. Why I'm saying happy enough? Simply the reason being he is entering into a contract from his own will, right? No one is forcing him at the gunpoint to enter into the contract. So farmer is ready to sacrifice this 2 rupees loss, 2 rupees, sacrifice this 2 rupees for hedging himself. The farmer is happy enough to sacrifice these 2 rupees to lock the price at 10 rupees. So insurance theory says that the 2 rupees, that is the loss. It is not actually the loss. So there is no concept of profit and loss over here. So that 2 rupees, the farmer is willing enough to sacrifice is the insurance premium that he pays. Is the insurance premium that he pays, not period, but premium that he pays. So I am paying 2 rupees. I am selling this at to you at a 2 rupees cheaper cost just because I want to save myself. Why we take an insurance? To save ourselves, right? To save ourselves from uncertainty. That is why we take an insurance. Correct? Everyone. So why farmer is ready to pay this 2 rupees or to suffer this 2 rupees premium? Just because he want to hedge himself. In the exchange of safety, he is willing to let go that 2 rupees. To save ourselves, we take insurance. Similarly, commodity producers, in order to save ourselves, give the discount to the buyers of the forward contract. Commodity producers, in order to hedge themselves, to make themselves safe from the price volatility, give discount to the buyers of the forward contract. It may be spot price will less what forward contract we have done in this scenario. Spot price may be less, yes. So there is different theory which suggests if spot price is less and future price is higher, then the market would be in contango. And there is a different theory which argues in favor of contango. We will come to that as well. If we sell in 12 as contract done, as he will not be a part of insurance theory. No, if he sells it in 12, if he does not give any discount to the spot price, it won't be the part of insurance theory. Insurance theory simply says that commodity producers give a discount to the commodity buyers in order to hedge themselves. What is the safety he gets? The safety that he gets is the floor. The floor of the price is 10 rupees. He won't be selling this to less than 10 rupees. If price is going down to 8 rupees after 3 months, at least he is not making the loss, right? He is he is happy enough to sell it at 10 rupees. Let's say the cost price of producing that cotton was 9 rupees, and he has sold the forward contract at 10 rupees. So he's happy enough to make just 1 rupees profit. He does not want to risk 2 rupees loss for it or 1 rupees loss for it. So that is why, simply because he does not want to get into a loss, he entered into a forward contract selling it for 10 rupees. Which type of risk is there if we sell in 12 rupees? So there is no risk if he sells in 12 rupees, but he just want to find the buyer, right? Surbi, I want to sell my plot for 50 lakh crores. I won't get the buyer. It is a liquidity risk for me. I won't be able to sell it at the price that I want. No, we cannot change the price. Although forward contracts are customized, there should be mutual agreement between the two parties to change the price, unless if only one party wants to change the price, it won't be possible. If only one party wants to change or fluctuate the price, that won't be possible. Simply, guys, he had made the cotton for 9 rupees and he wants to sell it for 10 rupees. Whatever may be the prevailing price of the cotton, he is happy with 1 rupees profit. He just want to make sure that he does not make any loss. Fair enough with him. Why are you judging him? Why are you guys judging him that he is a fool of selling at a 2 rupees discount? Insurance theory simply says that the farmer is giving a discount of 2 rupees just to hedge himself. And being in a democratic world, he can do so, right? He has all the right to enter into a contract and offer that at a 2 rupees discount. We can't judge anyone, right? Everyone there with me? Shall I move to the next theory? My dear friends, insurance theory was logical. Do you found insurance theory to be logical? Do you found insurance theory to be logical? Okay. Some of you are saying yes. GS is saying no. Almost all of you are saying yes, and only GS is saying no. GI is saying somewhat logical. The problem with insurance theory is market was, markets are, not was, but markets are. Yes, GB, tell me. How can I help you? Please ask your question. But if the price is already fixed in the contract, so what they are saying is the price that is fixed in the contract is discounted based on the spot price, not the actual price, not based on the price of the contract. So price is not going anywhere, guys. Please listen to this. So if the price is, if it is giving discount, it is giving discount on the spot price. So something worth 12 rupees is been agreed to sell for 10 rupees 3 months down the line. It is worth 12 rupees today. So the price of the forward contract is never going to change. Please think about it. The discount is based on a spot price SK. Okay. Someone asked me, VT. VT, are you clear with this? The discount is not with respect to future price or forward price, but the spot price. In future, the insurance policy is applicable. Yes, you are true. You are good. Good. GT. Sure, I'll explain again. Today, the price of cotton is 12 rupees. VT, today, price of cotton is 12 rupees, but you are thinking that the price of cotton will fall to 5 rupees. And you have bought it for 9 rupees. The production cost of cotton for you is 9 rupees. And you are assuming, or you are forecasting, or you are projecting that price of cotton is going to fall to 5 rupees. So wouldn't it be beneficial for you to lock the price as 10 rupees? Don't you think this makes sense? You are letting go that 2 rupees. Every one of you are letting go. NB, you are letting go that 2 rupees. You are not selling it for 12 rupees and giving 2 rupees discount so that someone can buy it 3 months later at 10 rupees. Just because to save yourself from price volatility. That is what insurance theory says. That is what insurance theory says. Now, now, the problem with insurance theory is markets were observed to be in contango most of the time. The markets were observed to be in contango most of the time. And that is completely logical. If something is priced at rupees 12 rupees today, in future, it should be priced at 14 rupees considering inflation. If something is priced at 12 rupees today, it would definitely have a higher price in future considering the inflation. So most of the times, not all of the times, guys, but most of the times, market was considered to be in contango. Was not only considered but observed to be in contango. So this says that insurance theory is not sufficient to prove. Insurance theory is not sufficient to provide the logic of market being in the state of contango or backwardation. So that nullifies the base of insurance theory. The second theory, which was introduced, was hedging pressure hypothesis. What was the second theory? It was hedging pressure hypothesis, which says that along with the farmer, the textile producer also wants to hedge himself. The textile producer also wants to hedge himself. Although it is true that farmer wants to hedge himself and lock the price, the textile producer also wants to hedge himself and lock the price because he don't want to witness the price increase. He is afraid of price increase of cotton being the raw material in his business. He also wants to hedge the price. So instead of 12 rupees, textile producer could be ready to pay 13 rupees for it. And if 13 rupees is the forward price, 12 rupees is the spot price, forward is greater than spot, what is the state of the market? What is the state of the market? Contango. So hedging pressure hypothesis says that along with the producers, consumers of the commodity or the underlying asset are also eager to hedge themselves. So hedging pressure hypothesis says, so PJ, you are a textile manufacturer. The today's price in market is 12 rupees. Correct? Okay. So what hedging pressure hypothesis says? Along with commodities producer, the consumers of commodity also wants to hedge themselves. And because of that, the market can be in contango or it can be in backwardation. So both of the states are possible. The markets can be in contango or they can be in backwardation. Now, if the commodity producer is more eager to sell, will the market will be in contango or backwardation? If the farmer is more eager to hedge himself than the consumer, if the producer is more eager to hedge himself than the consumer, what would be the state of the market? Correct? If the farmer is more eager, what I mean by more eager, if farmer is more pushed towards hedging himself, it means that he feels that prices are going to fall down. If the prices are going expected to fall down, farmer is more eager to hedge himself. He will have to give it a discount. And if there is a discount from the spot price, discount on the basis of spot price. So if there is a discount from the spot price, forwards are less than spot or spot is greater than forward, then the market is said to be in backwardation. On the other hand, if the consumer wants to hedge himself, then if the consumer is more eager to hedge himself, then the market will be in contango. So clear guys, clear over here. Everyone. So that was all from my end guys for today. Eager means more willing. Eagerness means more willing. More eagerness means more willingness. So hedging pressure hypothesis says that if consumers are more willing to hedge themselves, the market would be in. If consumers are more willing to hedge themselves, the market would be in contango. On the other hand, if producers are more willing to hedge themselves, then the market would be in backwardation. No, Rohit, actually, we have our international students on board with us as well. So that is why we cannot use Hindi words during the class. Yes, true, GA. Till an extent you are true about it. So guys, I'm sharing this sheet. Do you suggestion for economics like they will be suggesting any ebook or something? Actually, if you see from the curriculum point of view, we have discussed everything in depth and that would be sufficient enough. So I won't want you to, because as an investment banking curriculum, it involves various different things. So you can't just go on reading a whole together complete book on each and every topic. Previous PDFs, just give me a second. These are the previous PDFs. For that as well. So if you have been showing absent and all those things, any technical glitch about those things, you can raise a ticket about it. Yes, yes, these are the same sheets that I discussed in the class, same last class. Only eco and derivative sheet is the new one. So please download that only. Those who have all the sheets from the last class, just download the eco and derivative sheet. Yes, KK. So, Kanchan, if you have any doubt regarding attendance, you can raise a ticket. The team will get in touch with you. Yes, yes, the that PDF will upload it on the LMS by tomorrow itself or today itself. Let's see. It will be uploaded on LMS by today itself. Don't worry. So bye bye guys. Thank you. It was a wonderful session interacting with you all. Thank you, Ace. Thanks a lot. Bye bye. Have fun. Yes, SK, tell me. Yes, SK, I'm waiting for your question. You told me to wait for a second. Okay, the sheet is been downloading. Okay. Yes, yes, I'll be there till end. Don't worry. So probably SK, you might have joined from a mobile device. That is why you might have not got the PDF in the chat box. So you will have to check LMS for it. So bye bye, guys. Yes, yes, I will be teaching all the subjects. Don't worry. I think it would be, let's see. I don't usually allocate lectures to topic. I see that how class is interacting and how what kind of depth in explanation is needed. And based on that, actually two lectures were allotted, but don't worry, I'll manage all those things. You just please concentrate on making your concepts better. That is going to help you in future as well. So thank you. Bye bye. Have fun.